Good morning and welcome to Money Control. Well, the market has been showing great strength over the past 1 week. Yesterday, it crossed the psychological mark of 20,000, which traders were waiting for. It hit an all-time high. Obviously, there was a note of cheer and optimism on the street, but this morning has started on a somber note. Across the board, we have seen correction, and leading the way, guess what? It is all the mid cap and small cap indices. To understand what are the driving forces, why these conflicting signals that we are encountering, and the way forward, I have a special guest, Sandeep Tandon from Quant Mutual Fund, one of the best performing fund managers over the past many years. Sandeep, thank you for joining me on this discussion this morning. First of all, tell me, what are the driving forces of this momentum that we have seen over the past 1 week, and how do you read into the correction this morning?
So I tell you, let's look at since you talked about 20,000, I also agree this is just a number, okay? But whenever you achieve that psychological barrier or you cross that barrier, people tend to celebrate, and there are a lot many smart guys who wait for that opportunity when everybody wants to celebrate and get excited. Those are the people who are able to book profit. This is a trend we have seen, when company results are disclosed, whether it's positive surprise or negative surprise, I think largely get factor and you see immediately reaction after the earning seasons or immediately after the outcome. So something similar happened yesterday. We hit all-time high. So a lot of people came with a thought process of breakout level. Let me participate, and smart guys exited. Okay, and the only difference is that it was a relatively steep sell-off. So I always say, look at from a behavior perspective. In the short term, is market is always driven by narrative. We think this is right information, right data points, the correct news, or whatever way you want to describe. But this is narrative. Okay, reality will be known in over a period of time. So in long term perspective, obviously, reality is different. Okay, that's the way we define these moments. But given the strong macro which we have seen for India, I don't think I have ever seen in my 30 years of my career such a strong macro, both in absolute and relative basis. So definitely, India looks very good. So India is buy on dip strategy. But you have to keep in mind that no move is going to be linear. We have seen a very decisive up move. We have seen some amount of euphoria in certain pockets. But if you ask me, a lot of question have asked this question, whether we have seen a euphoria market going to peak out, is going to correct again very sharply, and today some small trailer was there. So I think answer is big no. I don't think we have seen any classic euphoria. What we have seen in December 2017 or January 2018, where we saw massive euphoria, or something similar we spotted in small cap in September 2021, or we go back and talk about pre-Lehman somewhere in September, October 2007 globally. I don't think any such signs are there. Okay, which forces us to believe that we have peaked out, and hence one should be very cautious. Yes, sector rotation, stock rotation, one should do, and that's the only way to generate extra alpha in the frenzy when the market is showcasing one way up move.
Sure. Sandeep, specifically the move over the past 1 week that we saw, how do you read into that? Was that just a, technical sort of build up? Because we are getting a lot of conflicting views talking to people. One view is that this change in expiry that has happened has created a lot of, interest in the futures options market. And that has suddenly created a positive signals building into the futures and options market, which is what has driven the move over the past few sessions. I'm asking this question also because in the past 6-7 sessions, you've seen FII sell and yet the market galloping. So how do we read into this last 1 week? I take your point that today may be profit booking, but usually the moment you cross a new high, you're not you're not in sell mode immediately. Or correct me if I'm wrong.
I tell you, Mahalakshmi, there is no hard and fast rule like this. It depends on the circumstances, what the background it is. So let me give you much larger perspective first, and then I'll come to you for your very near term, or let's say last 1 week movement we were talking about. See, we always look at market from a larger thesis. So like if you go back and see when market rallied in January 2020, June 2023, okay, globally, and something similar happened in India. So every bull market has a leadership status, okay. So that bull market was driven by predominantly by FIs. So FIs made tons of money in that cycle, and that cycle peaked out till September, October 2007. So they made good amount of money. Now let's look at the next bull run, which started in somewhere in March 2009 and which lasted till December 2017. That bull run was driven by ultra HNIs, family office. Okay, those are the segment which made extraordinary money. Now come to the last bull run which we are unfolding right now from April 2020 onwards when COVID stuck us. That's the time real retail participation has increased because all the smart guys, so-called ultra HNIs and family office and even institution participants, they were very much reluctant to participate given what was happening on the global basis. So the scare was on a higher side and retail participated. So in the current bull run is driven by retail. Okay, that's point number one. Now, if you look at the base of real retail, is very large, and hence this bull run has more legs. And in terms of timeline, it can even last as high as maybe it's a decade. So, which bull run which started, let's say in April 2020, has potential to go up to April 2030. That was the timeline. If somebody looks at the larger thesis, we also say that believe that this decade belongs to India. Maybe half century belongs to India, but this decade definitely belongs to India. So one has to understand it is retail who is in the command. Okay, and retail is not as immature as it was in the past. Okay, people used to make fun of retail investors. The retail come actually at the peak of the cycle. No, this time they have extraordinary M2M games which happen. So I think they have become much more mature. I'm very, since we deal with retail investor and their psych being as running a mutual fund, we understand them better than others. And I can tell you they are more mature. They are taking very calculated risk in the market. They're deploying their savings. So this has much more potential. Now come back to the market from a let's look at from a very near term perspective. Okay. Yes, some amount of selling happened, the FIs are selling. See, my worry will only come the leadership if the retail start dumping money, okay, and the mutual funds flows become extremely negative. So the leadership, this is driven by retail. When they turn cautious, when they turn negative on the market, that's the time I will be cautious. FIs are anyway not in the leadership situation, so their data does not make much difference to us as an analytic aspect. So if I look at purely from the analysis perspective, it doesn't disturb me much because they are not in the driving seat. That's point number one. Second point you have to look at is that the left out feeling. Okay, particularly for all extraordinary smart people who were they were more cautious. You talk to any HNI, talk to any family office, they were more cautious. Talk to any wealth manager. Okay, everybody was worried if this sort of euphoria is happening. Market doesn't look good. So market typically, when everybody believes that market is peaking out, is the reverse. So it rallied significantly and sucked lot many players. Okay. So I don't think this is the, you can say with some amount of, at least it is not backed by data. It is saying that, yeah, this is a great long-term top is in place and one should be out of the market. I don't think it's a small correction. And it is always healthy to have these decisive correction because all weak players are thrown out. So I think I'm more constructive on the market. Yes, correction was due, and if it lasts for a few more days, even it will be better.
Sure. Sandeep, tell me a little more about, your reading of the retail investor sentiment. You said that this time around we can't shrug off retail, which we've done in the past, because all anecdotally, if you wanted to, gauge the market, usually, panwala bolta hai to bechne ka, all these things are, very well chronicled. But this time around, indeed, the retail investor has been a big force, and especially you've seen that play out in the F&O volumes. Uh, Tell me your sense of, why do you say that the retail investor is truly mature this time? Because if you look at participation, increase in participation, majority of that has come post-COVID, and we haven't seen any steep correction thereafter. So are we confident about how that segment of investor will really react to corrections and how that could pan out? Because with FIIs, we were always very clear that, I mean, if there was fire sale, then, you know, all hell will break loose and you could see 30%, 50% correction in very short time period. But with retail, what is your sense? What could be their motivations and driving force going forward, and what could derail their sentiment?
So, first of all, Lalakshmi, it is again a myth, where we say that retail is participating in the future option segment in a way. Maybe a small portion of that segment they will participate, and as you know, 90% or rather 99% people don't make money in the leverage segment. It's only 1% people who make money or maximum. This is a global statistics. Very limited people make money, and so that 1 or 2% of the people make 90% of the money in the derivative segment. So a lot of people will come with some amount of experiment, they fail and they go back. So if it is not fair to say that real retail is participating in this segment, it is largely the HNI type of people. And when I say you have to quantify anybody has more than 50 lakhs of net worth to deploy in the equity market, I don't consider them as a real retail. Okay, so the definition can vary depending on the which city we are talking about, which type of people you are dealing with. So it can differ. Okay, but largely they are not present. So it is again a big myth which people sell go retail participation side, and I think good they are not participating because people have burned their fingers badly in the past also. Okay, this is a very specialized segment. When you get into leverage, at least you should know. And we also always tell is best used to participate through mutual fund route rather than going directly because they
Right,
don't have that capability.
right.
Okay, now when it comes to the psyche of retail investor, I say more mature. See, maturity is again a behavior number. Okay, if you have generated more profit, the conviction level or confidence level, what I defined from a behavior science perspective, it's the risk appetite of retail investor. Okay, so risk appetite of retail investor has significantly high as compared to the past because this time they were carrying M2M profits. Okay, and the 2020-21 M2M profits are significantly high. Okay, for them, they have never made that sort of money what they made in those 2 years,
Hmm.
and hence their conviction will remain very high. And this is very important. We are trying to see look at the folio which has continuously increasing the demat account which is getting open, and India is not first of all you look at the overall risk appetite as a country is rising. The liquidity position as a country is rising. Then you look at come to the capital market, the depth and the breadth of the capital market is also growing exponentially. It is growing. So I think all the data points which we want to see from a longer term perspective are very constructive, obviously, which will attract. And look at the feel factor.
Hmm.
The feel factor is also very important, irrespective of what I'm not getting into political aspect. But if I think Mr. Modi has done a fantastic job, he's a great brand ambassador for this country.
Hmm.
Okay, and that reflects in our P multiple, the way G20 happened, the way he conduct himself. India is in a different league. Okay, that's why I said it's the best macro which is there. So India is a league has changed, and what is to get reflected to reflect in the higher P multiple. This is another myth. A lot of people say this much multiple we have seen, and hence it is speaking out. Even the way earnings can expand, the multiple also can expand. Okay, you have not seen it because you have to look at on relative basis when globally people are not doing well, economies are not. Money will shift towards India. Money. We are very constructive on Asia-centric emerging market and India in particularly. Maybe in next decade we talk about because the risk appetite for the developed market has peaked out in September 2021 from a longer term perspective. Liquidity is shrinking in these markets. Ultimately, money will shift. So if I combine the risk appetite and liquidity, which reflects into our money flow analysis, that will shifting towards Asia. If 8-10% money shift towards Asia and India in particular, there will be tsunami out here.
Sure.
So I'm not trying to give you a very aggressive picture, but we are trying to say neither we are giving a bullish picture, nor we are trying to counter the bearish argument which is there. I'm trying to give you a realistic perspective how India perception is changing, how India is now the perception, which what the way is to look at both an absolute relative is very different, which will re-rate the country, which will also attract massive flows towards this country, and overall picture is improving. So I think one should not be in a hurry to book profit. A lot of people come and say, it's peaked out, let me withdraw money. I don't think so. That is the case. Yes, sector rotation, stock rotation will keep on happening. Certain pockets, like you look at defense sector, railway sector, some power sector, we have seen extraordinary hype. very recently, if some of these stocks correct, then I think this is equally healthy. But if you look at the structure aspect for railway or defensive or the PSUs in general, are very constructive. They were trading at very still trades at very attractive level for me talking about the public sector companies. So I think it's a this decade belongs to value as a thesis. Uh, and within that value thesis, emerging market qualify. So within India also the value stocks will deliver better return. And this is what we are saying from right from 2019 that this decade belongs to value. Okay, but no move's going to be linear. It's not like every time value stock will one way move up. There will be phases where growth will bounce back. But if somebody is looking at a decade view, I think that's a thesis which you have to believe, and it's worked very well for us.
Right. I'll come to the, two bits you talked about, sector rotation and of course specific sectors like railways, defense, power, etc., which have seen a lot of momentum. But before that, you talked about FOMO, right? Give me a sense of system-wide, institutionals, a lot of fund managers we speak, many of them don't take cash calls. But on the private side, a lot of people have been, as you rightly pointed out, sitting up the cash levels a bit and sitting on cash. Over the next few weeks and probably next 2-3 months, how do you see this playing out? Do you see a lot more investors, FOMO causing a lot more investors to come back into the market? Will that create its own momentum, or people will wait and watch still?
So purely at from our quant perspective in terms of our own analytics, we don't define as a FOMO. We look at the euphoria, okay, which is scientifically we can showcase through numbers. As I said, there is no classic euphoria or extraordinary euphoria which we have witnessed, so which one should be worried about. In fact, look at the background. Since you are also asking these questions, also showcase the concern which people have. If you go back and check your own statement in December 2017, this we asked, look at your own trade, this your own recommendation, you will get answer. What was the situation in September 2007 and what was the situation in December 2017? You will get answers because everybody is suddenly talking about there is a euphoria, market is speaking out. As long as fear remains in the system, market will remain healthy. Okay, so I will wait for a scenario where this fear will convert into some sort of extraordinary greed, extraordinary hype, which we are not seeing at the broader level. Yes, sector specific, stock specific, yes, we have seen to certain pocket, we have seen euphoria. Maybe those pockets will correct and consolidate maybe for a month or for a few quarters also. But larger thesis still remain constructive. So it's not a great strategy to take a cash calls. Instead of I will take a rotational call. Okay, and this is what if you talked about our outperformance, what we do at Quant is mathematically we try to quantify these things with what type of environment we are in, whether it's risk on, risk off, extreme risk on, extreme risk off, and what type of money flow analysis or sector rotation we. With the help of predictive analytic thesis which we run, we are able to do it better. And since the larger thesis and longer term perspective, India remains very constructive and very attractive from a global point of view, does not make sense for us also to raise very large cash and sit tight. And in fact, the people who have done that, they are suffering today. And this is one reason
Yeah,
what is like a sudden spike you see in the market because one day their patient will be tested and they'll come and give it up.
right. Right. So, Sandeep, going back to another point that you made about sector rotation, if you see since March, the rally has largely been led by mid caps and small caps. In fact, micro caps also for the longest time, I think 15, 20 weeks, you have seen absolutely continuous one side movement. On the contrary, large caps have been pretty much in hibernation. So, do you see a reversal of sorts over the next few weeks? Do you think large caps will resume their way up? And especially going by today, because today, if you see the worst hit are really large, the small caps and mid caps, 3%, 2.5% kind of cut. Is that although one day we shouldn't read into one day too much, would you see that as an early indicator of sector rotation in order for the next few weeks?
So yes, I agree with you from a very near term. I'm using the word very near term.
Right.
Yes, we have seen some signs of euphoria in certain pockets, which and obviously after today's steep fall, it will force people to book profit in small and mid, and maybe even recovery will be used to book profit and switch towards large cap. That's a human psyche. When you get fear, suddenly there's a small deep correction, then people get worried and people will do that. And that's the way this market works. Sometimes mid and large small outperform and then money shift towards large, and vice versa is also. But let's look at, so from a near term perspective, your analysis or judgment is absolutely right. It will happen. And today we have seen that, and I think it can gather momentum. So even if you look at our as a fund house, also what we have also done the something similar in last many days. We are increasing our large cap exposure. We are increasing our banking exposure. We are increasing our pharma exposure. We are increasing metal exposure where we have a comfort factor, and we are pruning down exposure in some of the sector which we talked about. We have seen some hype, but if you look at the larger thesis for India. Okay, India risk appetite on relative basis to US and developed market is significantly low. Okay, and it is improving. So this is a very important statement. And liquidity is shifting towards emerging market. So it's a lethal combination for a country from a longer term perspective, that money will keep on pouring to this country. And with that background, mid and small cap will by default will deliver better return. If somebody has a, let's say, decade view, okay, and if I said a decade view is very constructive for India, both on absolute and relative basis, so obviously mid and small will outperform. Okay, from a longer term perspective, if somebody has only 3 and 6 months view, and this is what I said, the retail has become much more mature. Okay, they have understood the importance of long term investing in this country, and that's the reason the growth of mutual fund industry is there. The very tax efficient vehicle offer them great product with 10% long term tax, and with the help of sector rotation, I think they are generating massive alpha. And since regulation for mutual fund is highly governed by from a regulator perspective, I think the comfort factor in the industry towards mutual fund has increased for the retail point of view. And I think this is the early trend. Okay, and I think this trend will only gather momentum. We are not giving you a biased view since we run a mutual fund, so it's a very naturally I have to talk about that. I'm just giving you purely as an analytic point of view. This is the very early stages where we seeing this momentum is getting built in terms of money getting shifted from a saving pool towards equity, and again from a longer term perspective. So if you recollect even 2022, since we have largely 96% of money come from retail investor at our mutual fund, we have spotted very interesting that even when I say retail become more mature and market fall, our inflow actually increases. When market rallies significantly, the flow actually comes down. Okay, so it's a very clear signs of the maturity with the retail investors when they are buying on dip sort of thesis. And most important aspect is that even let's say talk about after 2020-21 calendar year, when market has given extraordinary return. 2022 was challenging. I'm talking about calendar year
Right.
2022. But as a mutual fund, if you look at go to the amphi data, it is continually positive. As our end also, we saw huge inflow in 2022 also, despite market has not gone anywhere and has given negative returns. So look at the maturity. They understood it's a buying on dip and money keeps on pouring. So I think something has changed, which market is not willing to acknowledge that. Market participants still think, retail, the treatment for retail is getting, it's not, they never got that respect. I think this is the first time retail participant getting respect. I always define from a behavior perspective, they are in the driving seat, you better respect them.
Absolutely. So going back again to another point that you made, Sandeep, on value being the theme of this decade. Traditionally, you've seen all these years, except before COVID. I'm saying post COVID, of course, as you said, the narrative changed. The belief was that value stocks never outperform growth stocks in a growth country like India. Why do you say that value will be, the outperforming style over the next decade?
So I tell you, look at it's not just about India. When we look at the market from a global perspective, when we look at the money flow analysis, let's say it's September 2021, which we spotted that money flow towards global equity was at multi-decades high, could be lifetime high, whatever 40, 50, 60 years data. Okay. So it was lifetime high. And then you look at the background, September 2000 or October 2021, we also spotted that euphoria. And if you dissect the euphoria between growth versus value, we can do it in multiple way. we spotted the euphoria was not in value. The euphoria was confined to new age companies. Euphoria was confined to technology stock, growth stock, developed market stocks. So it's a very classic indication that growth cycle we started somewhere in August 2012 globally. It lasted till September 2021, maybe more than a decade it lasted that cycle. That cycle has peaked out. Okay. And since we are student of analytics only, so we look at these data point not only from India, from a global perspective. And I can tell you this the cycle of growth at any price where maximum people have grown in India and the thesis, okay, that was the period which did very well. But something has changed, and we are at least with the help of predictive analytics, we can endorse you this thesis. This is the way it has played out. But again, I will always say, so it's a as a mutual fund when we run our product, it's not we don't buy growth stock, we do buy growth stocks. So the blend is very important, but our portfolio is more skewed towards value. So that's the way we try to optimize the opportunity between growth and thing. Till September 2021, even our portfolio were more skewed towards growth stock. Again, even one can debate growth versus value on various parameters, but I'm telling you, let's look at from a purely from the valuation or the perception perspective. Like public sector bank, always a value was there, dividend yield was very high, okay, but no, there were no takers for that. Now something suddenly the PSU stock has gone to the roof, okay, whether now people have different narratives to answer that, their monopoly status, unique companies, India shining campaign, PLI, and all. This list can be expanded further. So I always say short term is all about narrative, long term is a reality. So if I have to look at larger thesis from a longer term perspective, I think it makes more sense to have a value assess skewed in your portfolio rather than growth. It will give me better outperformance and hence better alpha and better risk adjusted return also, because risk in growth stock or the new age company is still very high.
I put it this way. I mean, when you say value will be better than growth, for example, in the context of banks, do you mean to say that public sector banks will be a better play than private sector banks? Do you mean that, in everything else, for example, let's say if you were to play defense, you will play the stocks, which tend to be usually, enjoy lower multiples than the private sector players? That would be a better play. And in the context of economy stocks itself, there is a wide range in terms of valuations, because optically, if you see some of those economy bets in anticipation of growth are looking like they have very high PE because the earnings are depressed. So how do if you can simplify this whole value equation in your mind for our audiences?
See, uh, in real life, people talk about fair value, absolute value. So I think the as a house, when you talk about quant mutual fund, we look at absolute data equally, but we give more weightage on relative aspect because we are student of theory or relative. Because in life, everything is relative, even returns are relative. Okay. The moment you start looking on the relative perspective, and relative not from a technical point of view, a lot of people look at I'm looking at RSI. No, when you're looking at a larger relative thesis, then the potential up move or upside in these growth names looks more attractive. If you look at even last 1 year or last few months or few weeks also, when you're talking about very short term and near term, the PSU banks have outperformed the public sector banks. The PSU index is the biggest outperformer in the market as compared to any sectoral indices. So that itself give you some perspective, and it will remain like this because these names are relatively underowned. So as compared to growth stock where over ownership is there, in public sector bank grossly under owned, nobody wants to touch about it. Okay, they're untouchable for lot many money managers. They say, oh, we don't buy PSU banks. We don't buy PSU as a thesis. Okay, I think that is changing. And so that's the reason we are saying we are at the inflection point. We are completely unconstrained house. We are agnostic to thesis or style, or we are agnostic to sector, whether it's public sector or private sector. We are completely agnostic. We are pure opportunists. I think that's the best way to play this market. One should not get associated or even in the mindset, ki, this I don't want to buy, this I will never touch it, or this is very expensive. Okay. So depending on the combination of data points, we tend to participate wherever we can optimize these such opportunities.
Where else do you see, let's say from a 1 year perspective, what are some of the areas you would recommend as alpha generating opportunities?
So if I look at the sector, we recently launched our pharma fund. So we generally try to time the market, and timing is not about trading. Timing is a risk mitigation tool. Okay, if you can time it through analytics, you are able to reduce the risk. We always say thematic schemes or thematic funds, the risks are always on the higher side, but you can time it thematic fund better in your favor, then you generate extraordinary alpha. So with that background, we are definitely looking at the healthcare as a space or pharma as a space. Definitely look, it has reached those neglected territory areas and where people have given up. That's the one area we like a lot. Even metals looks good, irrespective of noise of the China and irrespective of dollar index, because all those correlations have broken long back. But people track these things more from a sentimental perspective and still get associated with that. If you look at India will grow, India infra will grow. So in material stocks will not deliver, steel and cement will not deliver in this country is not going to happen. So the entire material basket looks good, and within that metals looks particularly very good because they are trading in the most neglected zone. Okay, nobody wants to touch these names. Okay, given the background of the China related sentiments or the commodities related low P multiple, I think that's the one area we like. We like still like overall manufacturing as a theme. We still like media because that's another area which trades in a massive neglected zone. Real estate has come after, has recovered a lot in last as compared to whatever we have seen from 2008. So another area which we believe has potential to move up. So this is the sector which we like, and obviously, if manufacturing as a thesis will going to grow, infra as a country, if we going to grow, I think then if you ignore banking, then it's not going to be fair. So that within that also we within financial I say we are more skewed towards banking, and within banking we are more skewed towards private public sector bank rather than private sector. But we are equally optimistic on select private sector bank also. But you have to avoid where over ownership is there, because we have seen in certain stock where the extraordinary over ownership is there. Those stocks have not delivered in last 2 years or last 1.5 years.
Sure. I'm just seeing your portfolio, Sandeep, Strides Pharma, Bikaji Foods, Nitin Spinners, Arvind. A lot of pharma names, a lot of textile names that you seem to have added in the past month, quarter. So are you a cheerleader for textiles as well?
So we,
Because
as
there
I said,
also a lot of
overall,
stocks have really gone up quite sharply.
so we like that space. We like overall manufacturing, auto ancillary also we own. We own textile also. So even textile looks good to me. But again, textile is also reached that neglected zone. Now it's a recovery phase. Okay, and maybe gradually we'll see earnings momentum will also follow because they went through rough cycle. I think they're coming out of that. So I think one should be constructive. And again, since it was trading in the neglected territory, people have given up in this sector. Pharma people have given in January, February, between first quarter of this year, people have given up. Okay, they've surrendered at the bottom of the cycle, and that's the time. Since as a house, we always believe we don't chase momentum. We are inflection point strategists. So we buy and sell stock with the extreme inflection points. And we spotted the textile few months back where the again it, since you talked about textile were the neglected territory. They were an extreme inflection point. That's one of the reasons we have rebuilt our exposure in the textiles.
Okay. Anything that is a complete avoid for you? And before that, I also wanted to ask you about the infrastructure space, because that is a space that has been, despite this momentum or the narrative building around economy picking up, infrastructure spending, etc., except for railways and capital goods, the infrastructure companies have really not taken off in a big way in terms of institutional ownership. So if you so how do you look at that space?
So anything which is linked with construction, one should look at. The only challenge is that you have balance sheet issues with most of such companies. Okay, they have perception issues, they have governance issues in some of these names. So people are generally skeptical about participating in this sector. So that is something we have to be keep in mind. But what is important for us to understand that let's talk about capital good for 2 minutes. Yes, we were very early to spot that, but if you ask me whether I'm going to increase my exposure, answer is big no, because we have seen over ownership in this sector now. So anything which becomes grossly over owned, we tend to avoid. Okay, because the upside get capped because everybody whomever wants to participate it has already built the exposure. So you will not able to make much money out of that, despite we remain very constructive on the capital goods stock from a longer term perspective. But I think you have to look for unique ideas, and within that also sometimes stock correct for whatever reasons. Okay, and if you like that sector, since we remain constructive on capital goods as a sector, if we sometimes we get opportunity, we will do participate in it. But from the current level, slightly expensive, grossly overowned. So what you ask me, what you have to avoid? You have to avoid grossly overowned and most admired territory stocks. This cycle is all about under ownership and most neglected zone or hated stocks, but who have not performed for last 10 years or 1 or 2 decades also. Those are the names which will do better as compared to the stocks which were trading already in the most admired territories.
But Sandeep, one contradiction I see in this is that, just by virtue of its presence in the, heavy weight in the index, the banking sector is always over owned. Of course, people may have equal weight, but much of the institutional money, if you see, is overweight on banking. So how do you read into that?
See, it is very unfortunate that all active money manager also try to mimic the indices up to large extent. So they are not active manager; they're quasi ETF or
Index huggers.
quasi passive product they offer. So we take the fees of active, but we offer quasi product. So that's one point. Okay, and this is one of the reason the retail has become so mature. He has understood this game very well, and that's the reason globally the ETF or the passive product have grown significantly, and so is the case in India also. That's point number one. Point number two, if you have to talk about from the as a house, we don't mimic indices in any manner. There was a phase between January 2020 till March 2020, much just before the COVID. We exited all banking. We didn't have a banking name in our portfolio for more than a year. Okay, so what is very important for us to understand is that in today's world, the active money management has potential to generate better alpha because markets are very volatile globally. A lot of data points are changing on continuous basis. In that background, you can't have a very skewed portfolio. So even from a risk management perspective, we believe Nifty is a very skewed portfolio. Okay, and in fact, it is not a true index because all outperformers are inducted and all underperformers are removed. That's not the way globally indices are managed because indices represent the true picture of all the sector, which is so I call it Nifty as a more of a momentum index rather than a very great index. So it lacks those quality from a statistical perspective. And the one reason we also believe that any sector which is like high as 45% was banking was in the peak of the cycle. To have 40-45% exposure towards one sector is also not a great strategy from a risk management perspective. We generally don't go beyond 20% to any sector or any group, irrespective of the weightage in the index. And that thesis has played out well in our favor. It is a better risk management strategy rather than just having or mimicking the indices, which is very skewed.
Sure. One last question, Sandeep. Crude at $90, how big a risk do you see this as for the market? Right now, the market seems to be completely ignoring this. Could this spring a nasty surprise, and how do you perceive it?
So, Balashmi, if you read our predictive analytics note in the month of May, we talked about that between June to September 2023, energy prices will go up, particularly crude and the natural gas. And they did. So crude is also rallied significantly. Gas is up more than 50%, crude 30-35%. What is very interesting that now suddenly that everybody is more concerned about it. Our data points are showcasing that high probability that we either crude has already peaked out or in the final phases of peaking out from a medium and near term perspective. So I don't think that is a risk. Okay, rather we will look for those sectors in our portfolio which will be benefit by falling crude price rather than other way. So we have already revamped our portfolio, keeping in mind that the crude is in a it's an early stages of peaking out.
Sure. From a market perspective, is there any risk that you perceive at all, Sandeep?
See, if you look at India, I don't think we have any India-specific risk right now. Obviously, everybody believe that the election is the biggest risk, which is of next year, and a lot of people are already become very cautious about that. Generally, it's a mindset game. A lot of market participants 6 8 months prior to the election also they'll lighten up their position and say will participate other that. But my view is that even if I look at the overall data, I think that risk is also on the lower side. The probability, and I'm using the probability and whatever market implied data is endorsing is giving you some perspective. I think that risk is also on a lower side, right, as compared to what was in the past. That's point number one. If anything is there from a risk perspective, I think it will be more global rather than local. So we will track more global risk than the local risk currently, and even let's say closer to election, if somebody has to buy protection, maybe hedge for the uh, uh, any surprise in the election, one has enough time to do that. I don't think one should be cautious, or one should be taking that uh, bearish outlook sort of thing, keeping in my election is something can go wrong. I am not in that mindset right now. Maybe at closer to election, we will take review our data and maybe take a call accordingly. How the market looking good, how the risk appetite is changed, whether liquidity has improved or deteriorated. Maybe at that point in time, we'll take a appropriate call, and if need be, we'll hedge it. That's a better thing rather than sitting on cash currently.
Sure. Wonderful talking to you, Sandeep. Thank you so much for your time. I've taken up a lot of your time, but thank you so much.
Yeah, thanks a lot. See you. Bye.
How do world leaders view India?
I've long believed that the relationship between the United States and India is will be one of the defining relationships of the 21st century.
The bright spot of the global economy.
The growth rate for India, which is 6.8 in 2022. Let's not forget, this is one of the bright spots in the global economy right now, such a high growth rate.
The potential of India is enormous, and you have now a reformer, a radical reformer, who has the ability to transform it.
On the verge of a big transformation.
इस अमृत काल में हमारे संकल्पों की सिद्धि हमें आजादी के 100 वर्ष तक ले जाएगी.
A magnet for investment.
I'm actually incredibly excited about the future of India. I think India has more promise than any large country in the world.
The world is bullish on India. Moneycontrol is bullish on India. Join the campaign. Tweet to us with hashtag MC Bullish on India.